Some stock market forecasters predict that the market's not going to gain or lose much value over the next several years, but will just plod along sideways. It's still possible to make money from stocks in this environment, according to Robert Hagstrom, a portfolio manager at investment firm Legg Mason and the author of 6 books, including The Warren Buffett Way. Hi, Robert. Thanks for joining us.
Jack, thanks very much for having me.
So you're not necessarily predicting that we'll have a sideways market, but you think that investors should be prepared for that possibility.
Well, it's certainly become conversational, as you said, and no, we don't make forecasts about market. I really don't know what the market will do over the next 6 to 12 months, but because it's become such a big topic, we wanted to investigate the behavior of stocks in sideways markets to see maybe what opportunities would be out there.
So at MoneyWatch, we spend a lot of time telling people to invest in index funds. But your contention is that if we should get the sideways market, investors will leave a lot of money on the table in that situation.
It would be problematic. You know, an index fund today may be a S&P 500, 2% yield, slightly below that. And if we go sideways, like we did from 75 to 82, that would be about the rate of return that you would get in an index fund. That's not going to be too glamorous.
But you have to be an awfully good stock picker to actually beat that 2%.
Yeah, no doubt this is the challenge. And as Warren Buffett said, you know, if you're a know-something investor, that you have the skill set to identify mispriced stocks and good businesses, then you should put together a portfolio of high-quality stocks that are good values and hold on to them for a long period of time. If you don't have that skill set, then you should either find someone who can do it for you, or you're going to index it. But just be aware that if the market is sideways, indexing is not going to be a high-return investment for you.
What are the mistakes that most active managers make that obviously Warren Buffett does not make?
Well, think about Warren. He owns a few number of stocks and he holds them, Jack, for a long period of time. What we've seen in money management today is that our turnover ratios are way too high. People are trading stocks, not investing in stocks. And the research that we did on the sideways market pointed out very clearly that the big home runs in the stock market are stocks that are held for 2 years, 3 years, up to 5 years, not 2 months, 3 months, 5 months. And in our business, I think we're trading stocks, we're not investing in stocks.
Now, even given that, you need to take away that mistake and many others that they make, we know that fewer than half of the active managers will actually do it right, pick stocks that beat the market. So as an investor, how do you know which mutual fund to go with? How do you pick the guy who's in the minority of winners?
Well, it is a challenge. I do think historical performance is important. I think if you look at a manager who has had a long-term track record that's above average, that also has as a process buying individual stocks and holding them. Look at turnover ratios, look at the holding period of the portfolio. If you can put that together, then I would think the odds are increasing in favor that you probably have a pretty good investment.
Could we take one example from your portfolio that I think is an interesting example of active versus passive?
Yeah.
Apple.
Yes.
Great company, phenomenal products. I mean, obviously it is beyond category leader. And yet, do you really want to own that stock? I mean, it seems to me all that excitement is priced right in.
Well, I think it's not as expensive as you think it does. If you take the cash out, about 30-some-odd% of the market value of the stock is actually in cash today. And if you take that out and look at the core business, it's trading at the market multiple on a cash flow basis. So it looks pretty cheap to us relative to how it will grow. And you also don't want to think just because the stock went up 100% that necessarily it's not going to do well. A lot of stocks have gone up 300%, 500%, even 1,000% over a decade's period of time. But you have to hold them long enough to get them. Just because it went up 50% or 100% doesn't mean it should be sold automatically.
And how do you know when to sell?
Well, it becomes overvalued. I mean, you have to do some math here. At which point the stock price is above the value of the business, then you're obligated to sell because your rate of return is going to go down. It will be, you know, less than what the market rate of return is. But if you can make a case that the stock price is either fairly priced or undervalued relative to the business, even if it went up 100%, there's no reason to sell it. Another stock that we've done very well in is Amazon. And talk about a bumpy ride, but you know, our average price on Amazon is about $12 a share. You know, today it's, you know, north of $100, and so we've made multiples. Had we sold it at 24 and gone up 100%, we wouldn't have gotten 5 times more of our money over time.
If there's one piece of advice you could offer investors right now, what would it be?
Well, I think if you're going to be in the stock market, get a big dose of patience. Slow down, buy quality, stick with quality over time if it's reasonably priced, and you'll do well in the stock market.
Thanks very much for your insights, Robert.
Great. Thanks, Jack.
And thank you for watching.